Welcome to Business 451, Venture, Formation, and Finance. This session covers in brief the concepts of risk and return and the time value of money. These concepts are fundamental to understanding valuation. These are the terms you should know from this discussion. You should return to these concepts at the end of the session and be sure that you understand them. Let's start with risk and return. The relationship between risk and return is very straightforward. The greater the risk of an investment, the greater the return it must provide to investors in order for them to be willing to invest in it. For an investment with a fixed return, this means that the higher the risk, the lower the price that the financial asset will have in the marketplace. This relationship is formalized in the capital assets pricing model, CAPM for short. CAPM gives us insights into the pricing of financial assets, assets that we invest in purely to earn a financial return. If we're investing in a wonderful piece of art, we might be buying it wholly to earn a financial return, or in part because we want to be able to enjoy the piece of art while we own it. CAPM will tell us something about the financial value of the art, but nothing about the experience value of it. For financial assets, remember, those are assets we're investing in purely for the financial return we get from them. The greater the risk, the lower the value of the asset. If two bonds both pay $100 per year in interest, but one is riskier than the other, maybe it comes from a company that is a less stable company, then investors will tend to choose the less risky bond, driving its price up and the price of the riskier bond down. Then the riskier bond, with a lower price, will earn a higher rate of return on the owner's investment. This relationship is illustrated in this graph of the security market line. As we are wanting to finance early-stage ventures, the risk is very high, and so the return required by investors is going to be high, unless you have a way of lowering the risk. Thus, a startup venture will not be able to raise debt capital unless the debt is guaranteed by an individual or entity that has sufficient assets and cash flow, both assets and cash flow, to lower the riskiness of the loan to levels a lender can accept. And equity investors will demand large chunks of ownership for their investment to provide sufficient upside potential, if they are willing to invest at all. Now let's see how this risk-return relationship plays out with equity capital. To understand how we think about risk, we need to understand how financial analysts define risk. They look at risk as the dispersion of possible returns from an investment. If we have two investments that have equal expected returns, but one has higher probabilities of very high or very low returns, we identify that investment as the riskier one. We can then measure risk as the standard deviation of the distribution of possible returns from an asset. Let's make sure that we can calculate the rate of return on an investment. The rate of return is our gain from the investment divided by the amount of the investment. For example, we might pay $100 to purchase a share of stock that pays a $10 annual dividend. If at the end of the year we sell the stock for $110, then our total gain will be $20, the dividend plus the capital gain, and our rate of return will be 20%. $20 divided by the $100 that we invested. If there are multiple possible outcomes from an investment, we can calculate an expected return by weighting the possible outcomes by their probabilities. If we are considering an investment that has a 30% chance of a 60% return, a 40% chance of an 8% return, and a 30% chance of returning negative 6%, then the probability weighted expected return is 20%. We can show this graphically. The top graph shows the distribution of the expected rates of return for two companies that have equal average expected returns, but one has a much wider dispersion than the other. High-tech in the graph is the riskier stock. Given that the expected returns from high-tech and biotech are the same, we would expect a risk-averse investor to choose high-tech over biotech. But which one would you choose in the lower graph? The lower return with less risk or the higher return with greater risk? The choice is not so clear. Find out a little bit about yourself. Which one would you invest your money in? In summary, the greater the risk, the greater the return that investors will demand. New ventures have very high risk, and so investors require very high rates of return to invest in them. This makes it difficult for new ventures to raise debt capital. Given equal expected returns, risk-averse investors will choose the less risky investment. Besides risk, the other key factor in valuation is time. Investors care not only about the amount of return that they get, but when they get their return. This leads us to the concept of present value, the value now of an amount of money received at a given point in the future. The basic principle is that a dollar received today is worth more than a dollar received tomorrow. If I receive a dollar today, I can spend it or invest it today. If I don't receive it until Tuesday, I lose that ability to spend or invest today, and I'm going to make you pay for the privilege of waiting until Tuesday to pay me. So that's the concept. Time is money. And the longer I have to wait to get my money, the more return I'm going to require. Now, to turn this conceptual relationship into a mathematical one, it's useful to start with something we're more familiar with: interest. Earning interest on an investment is about looking to the future. What will my investment be worth at some point in the future if I invest X dollars today at R interest? In a simple example, a dollar invested today at 10% interest will be worth $1.10 in 1 year. In 2 years, it will be worth $1.21, $1.10 times 1.1. In n years, it will be worth $1 times 1.1 to the nth power. A general formula is that the future value of an investment is that investment times 1 plus the interest rate earned to the nth power. Calculate the value of $1 million invested at 8% for 8 years. Pause the video now and make the calculations. Once you complete the calculation, start the video again and the answer will be revealed. Don't peek. The future value is $1 million times 1.08, 1 plus 8%, raised to the 6th power for the 6 years, or $1.587 million. Okay, so that's future value, what an investment is worth after a given period of time. But suppose we know what the value of the investment will be at a future point in time, and we want to know how much is it worth now. For example, imagine that we are considering investing in Nuco, an early stage company, and we think the company will be sold or will be worth $50 million in 5 years. If, given the riskiness of NewCo, we want to earn 30% per year on our investment, what would be the value of NewCo today? This is a job for present value. The concept and the mathematics of present value is just the same as future value, but we're going the other way. In present value calculations, we know, or think we know, what the investment will be worth at some future point in time, and we want to know what it's worth today, in the present. Its value in the present, its present value. Got it? The present value of $1 received 1 year in the future is $1 divided by 1 plus the discount rate. The present value of $1 received 2 years in the future is $1 divided by 1 plus the discount rate squared. The present value of $1 received 3 years in the future is $1 divided by 1 plus the discount rate cubed. The present value of 1 duck received goose years in the future is 1 duck divided by 1 plus the discount rate to the goose power. I should note at this point that the discount rate is just like an interest rate, but it's what we call it when we're calculating present values. Next, we apply present value methods to calculate the present value of a series of future cash flows. Suppose we're going to make an investment today, which will result in a given payoff in the future. How much should we pay for that investment? Directly relevant to the course, we are working towards calculating the present value, the value today, of a company that we have an expected value for several years from now. For example, if a company is expected to be sold for $30 million in 3 years, how much is that company worth today? Try these problems. Pause the slideshow here, make your calculations, then go on to the next slide. Wait for it. Make your calculations. So what is the present value of $2 received in 2 years if the discount rate, RD, is 5%? The present value is $2 divided by 1 plus the discount rate, 0.05, squared, or $1.81. What is the present value of $1 received in 1 year plus $2 received in 2 years if the discount rate is 10%? Now we have to calculate the present value of each of the individual cash flows. We can't add them together because we receive them at different times. So the present value of $1 received in 1 year is $1 divided by 1.1. And the present value of $2 received in 2 years is $2 over 1.1 squared. And the sum of those two, which is the present value of the two payoffs, is $1.73. What is the present value of the following streams of payments if the discount rate is 20%? $100 in 1 year, $200 in 2 years, $300 in 3 years, or $300 in 2 years and $300 in 3 years. Notice that the total payoffs are the same in both cases, but the timing of the payoffs is different. So which one is going to have a greater present value? The first one, the present value of $100 in 1 year, $200 in 2 years, and $300 in 3 years, is $395.83. The second one, the present value of $300 in 2 years and $300 in 3 years, the present value of that is $381.94. It's a little bit less because in the first example, we got $100 of our $600 sooner than we did in the second example, which demonstrates, of course, that investment payoffs received later are worth less than payoffs received sooner. Let's work with some other examples. Suppose you're offered an investment that will pay you $1,000 in 1 year. Your required rate of return is 20%. What is the most you should pay for the investment today? If we know the amount and timing of the payoff of an investment, and we know the rate of return we want from it, which would be our discount rate, then we can calculate how much the investment is worth to us today. In this case, it would be worth $1,000 divided by 1 plus the discount rate, or 1.2, or $833.33. That is, if you want to earn 20% on your money and you're going to get $1,000 in 1 year, you should not pay any more than $833.33 for that investment. Suppose that you are offered an investment that will pay you $200 in 1 year, $300 in 2 years, and $500 in 3 years. Your required rate of return is 30%. What is the most you should pay for the investment today? Our discount rate is 30%, or 0.3. The present value is $200 over 1.3 plus $300 over 1.3 squared plus $500 over 1.3 cubed, or $558.94. From this, we can see that the discount rate matters. If we receive the same amount of money with the same timing as we did before, but we want a higher rate of return, then we have to pay a lower price. One final topic under present value. Suppose you invest in a special bond which pays a fixed amount of money annually forever. This is an example of an annuity. How much should you pay for that annuity? The present value of the annuity is the present value of all of those payments. But there are an infinite number of those payments. It would take a very long time to calculate the present value of each of them, like forever. So, the present value of $1 received every year forever turns out to be $1 divided by the discount rate. The present value of an annuity of $A received every year forever is $A divided by the discount rate. So calculate what is the present value of $100 received every year forever if the discount rate is 10%. Make that calculation, pause the video, do the calculation, and then come back to the video for the answer. The answer revealed. Present value of $100 received every year forever if the discount rate is 10% is $1,000. That's the present value of that annuity. Now, what if the annuity grows at a constant rate? Suppose the annuity grows every year at a constant rate, we'll call that rate G. Then the present value is found by this formula, the amount of the initial annuity payment divided by the discount rate minus the growth rate of the annuity. Pause now and see if you can solve the problem. How much is an annuity worth that pays $100 to start, grows by 5% each year if you want to earn 10% on your investment? How much should you pay for that annuity? Pause now, make the calculation, and then come back to the video. And the answer is, if we receive $100 in the first year, and the payout increases by 5% each year, and we want to earn 10% on our money, then we should be willing to pay up to $2,000 to receive this annuity. Suppose we want to know if an investment provides us a return equal to or greater than a target rate of return. If we find the present value of the future cash flows from an investment and then subtract the amount of the investment from that present value, then if the resulting value is greater than zero, we've exceeded our target rate of return. If the resulting value is exactly zero, we have exactly made our target rate of return. And if the resulting value is less than zero, we have not earned our target rate of return. So net present value is the present value of the future cash flows minus our initial investment. This calculation is net present value. Let's look at a net present value example. You're considering investing in a project that will return $100,000 in year one, $200,000 in year two, $300,000 in year three, and $200,000 in year four. The project will cost $500,000 to complete. What is the net present value of the project if your target rate of return is 20%? So here's the problem. There's our payoffs. It's going to cost us $500,000 to finish it off, to get it set up, to earn that money. And our target rate of return is 20%. So the present value of those cash flows is, we've done this one before, $100,000 over 1.2 plus 200,000 over 1.2 squared plus 300,000 over 1.2 cubed plus 200,000 over 1.2 to the fourth. Or our present value is, better check my arithmetic on this, $492,284. Then the net present value, which is the present value minus the amount of the investment, $492,284 minus $500,000. The net present value then is negative $7,716. Once again, better check my arithmetic. So we got a negative net present value, which means we didn't earn our target rate of return, but did we lose money on the investment? The net present value was certainly negative, but the project was projected to return $800,000 on an investment of $500,000. So we clearly didn't lose money on it, but it didn't meet our target rate of return. Here's an important use of this. If the present value of a project is calculated using our weighted average cost of capital, remember that, as the discount rate, then net present value tells us whether we are earning enough on the project to cover our cost of funding it. In summary, not only the amount of the return, but also the timing of the return is important to investors. Simply put, they want their return sooner rather than later. Calculating the present value of a set of future cash flows is done by discounting each of the cash flows back to the present and adding them all up. An annuity is an amount of money that is received regularly forever. Net present value is present value minus the initial investment. You should now be familiar with all of these terms, and with a little study, you should understand them all. I suggest that you briefly pause the slideshow and read through the terms and see if any of them are unfamiliar to you. Go back and take a look again and make sure that you understand them. And that's all, folks. Now it's time to do the discounted present value problem set.